Hi everyone, welcome to Navigating Your Dealership Mid the COVID-19 Crisis. This is Ryan McDonald of O'Connor and Drew, presenting today on the recent legislation that has passed in response to the coronavirus. There's been 3 phases of legislative relief that have gone through. Most recently, the CARES Act, which has that small business loan provision, some tax changes. That small business loan, very important. Keep liquidity, keep everybody going. Hope everybody's staying safe, sane, healthy during this whole thing. I know just yesterday the president had announced that the social distancing procedures, if you will, are going to continue through the month of April, with hopefully the economic recovery starting at the beginning of June. So wishful thinking, hopefully within the next 2 months. Hopefully things will get back to normal, and within that 2-month period there is some assistance through these pieces of legislation to hopefully get everybody through that time. I'm going to be presenting on topics here. As I mentioned, we're going to touch on each of the 3 pieces of legislation, briefly on the first 2. I'm going to jump into the sick leave, family leave, and the associated credit program that comes from phase 2 of the legislative relief. The small business paycheck protection program loans, those are those small business loans that I was referencing. The rebate program, this is, if you've heard on the news, you know, a typical family of 4 is going to get $3,400, that kind of thing. Tax provision changes for both individuals and businesses. They did expand on unemployment. And then we've got some contact and resources for you as well. So touching first on an overview of the legislation relief, these are the three bills that it had passed through, HR 6074, 6201, and 748. These are in order. This is here mainly as a resource. These slides will be available for you if you did want to check the landing page on Congress.gov. You can see the actual bill text itself. There are some summaries as well. These are the 3 pieces that have passed so far. There are, of course, already talks for a phase 4, potentially a phase 5 coming out in the future. So the first of the 3, 6074, was essentially just a funding provision. Gave $8.3 billion in emergency funding for certain federal agencies. The funded programs are listed below here, as you can see. But again, this was mainly just a funding bill. The second one, Families First Coronavirus Response Act, included both the Emergency Paid Sick Leave Act and the Emergency Family Medical Leave Expansion Act within it. These are those sick leave and family leave pieces that we're going to get into shortly. It also expanded for some free testing for COVID-19, expanded the funding on unemployment, and this also touched on, you may have heard of some kids were getting, they still needed assistance with getting meals or breakfast and lunches through school programs, for example. It expanded that food assistance. And then the one that has the most meat to it, the CARES Act. This is the one that passed just recently. This has the payment protection program loans. This has the rebate check program. As I mentioned, several tax policy changes and unemployment expansion. There is also a mid-sized business loan program, which we don't dive into too much here, but definitely if you think it applies to you, feel free to reach out and we can give you some information on that. That applies to employers that have generally 500 to 10,000 employees. Those would be the employers that are not eligible for the small business loans mentioned previously. And then there was also some economic assistance for certain distressed U.S. industries and the U.S. healthcare system. On the industries, we've of course heard in the news, assistance for like airline industries, cruise industries, for example. There are some others in there, of course. So jumping into the sick leave, family leave, and the associated credit program. So sick leave, the employer covers a portion of the employee's pay, subject to caps, for up to 10 days or essentially 2 weeks. There are two scenarios where either you're paying for 100% of the employee's regular daily pay, which is subject to up to a $511 employee cap, or 2/3 of the employee's regular daily pay, subject to a $200 cap. So in other words, if you fall into the 100%, you pay $511 each day for 10 days, and that's where I think we've been seeing it's being reported as a maximum of $5,110 versus the $200 over 10 days is the $2,000. Employers with more than 500 employees are not required to provide this. And as far as determining between either the 100% or the 2/3, whichever you have to pay, the sick leave 100%, it's essentially for those that are quarantined or self-quarantined, or they're going to seek a medical diagnosis because they're showing symptoms, whereas the 2/3 is more so for those who are caring for someone else, or if their child is, out of school or child care provider is closed, which at this point seems to be the majority, I know, across the state. Similarly, there is a family leave provision which carries the 10 weeks following the 2 weeks of sick leave. This one is just capped at the 2/3 of employees' regular daily pay, up to $200 per employee. This one is a little bit more restrictive in when it becomes applicable. So this is for an employee that's unable to work or telework due to the need to care for their children because school or the place of care has been closed. There was a bigger net in the initial versions of the bill, but it was restricted down to just this type of benefit. Employers with more than 500 employees are not required to provide this, and those with less than 50 employees may be exempted by the labor secretary. This is essentially if paying this family leave would put your business into a going concern situation, then the labor secretary can exempt you from having to make this payment. At this time, I don't believe the guidelines have come out, but they were going to come out with a set of guidelines to make that exemption process fairly streamlined. Now, for those that end up paying both the sick leave and the family leave, or only one of those, there is a payroll tax credit that fully offsets the cost of that. So federal government fully subsidizing the cost. It comes in two forms, either a retention of your payroll taxes or an accelerated refund of the amounts that you've paid. So retaining the payroll taxes, you look at the amount of federal income tax withholdings, the amount of employee and employer Medicare and Social Security costs, so your payroll taxes, and whatever amount you would typically have to make a deposit of, that gets offset by the amount of sick or family leave you've paid. So if you normally, at period X, you would have to make a deposit of $10,000, but you paid combined sick and family leave of $8,000. Now you only have to make a deposit of that $2,000 net difference. For the accelerated refund, this is for if your sick and family leave exceeds the amount of the taxes. So going back to that example, say you had $10,000 that you typically have to deposit, but you paid $12,000 in sick and family leave. Now that difference of $2,000 in excess, there's going to be an IRS claim form. You submit that extra $2,000 to get refunded. It's supposed to be processed within a 2-week period. Self-employed individuals are also going to be able to claim this credit. Although some of the specifics aren't out there, it'll be claimed on tax returns, and this will allow individuals that are self-employed to reduce their quarterly estimated taxes as they become payable throughout 2020 and into 2021. Now, the big thing that everybody's looking at right now, the small business Paycheck protection program loans. I might refer to these as just small business loans, the protection loans, for example. Just as a high level, kind of the spirit of this program was federal government wanted to be able to provide payroll for the next 2 months, plus a little bit of operating costs for businesses, so that even if maybe the business has to essentially shut down over these next 2 months as a result of the coronavirus, you can still retain your employees. Everybody's still getting paid. Your utilities, your rent, your mortgage interest, all of that's still getting paid during this period. It was originally, I guess you could call it, advertised as a stimulus package, but it's more of a relief bill than anything, because again, it's not really, there's no real stimulus here. It's more of a just using the employer as kind of a conduit to give the federal funds to the employees, as opposed to having to do this through, various state agencies or from the federal government directly. This loan program allows the employers to kind of step in and serve that role. So the loan program has a forgiveness provision that essentially transforms the loan into a grant. I'll get a little bit deeper into the forgiveness section shortly, but basically you can look at it as, say you qualify for a $2.5 million loan, and you calculate that you can, well, in a best case scenario, say you calculate that you can forgive all $2.5 million of that. That's forgiven, you don't have to pay it back, and it's non-taxable. So in that sense, it ends up acting almost like a grant. This loan program is available for employers, including nonprofit 501c3s with less than 500 employees. And the employee count for this specific determination includes full-time, part-time, and other types of employees. So essentially all of your employees gets factored in. Now, a question that's going around, especially with auto dealers, is, if I have multiple locations and no single location has over 500, but across all of these I hit over 500, am I eligible for this loan? The short answer to that right now is that we can't be certain. There are some exceptions written in the bill, and different organizations are interpreting that differently. The two that we've outlined here, so the AICPA, National CPA Organization, made a statement that businesses with less than 500 employees per physical location are still eligible. As I've read the text, it seems like this specifically only applies to certain restaurant industries, but we've reached out to the AICPA for some clarification on that. And then secondly, you may have seen through NADA Communications that NADA has said that auto groups with the manufacturer distributor on the SBA's franchise directory list are eligible for this. And that corresponds to a part of the bill that mentions that exactly that businesses that are on the SBA's franchise directory are excluded from the affiliation rules. The issue we have here is just because you're operating a dealership for a particular manufacturer distributor, does that mean that just that manufacturer distributor's direct operations are qualified, or does that mean that every single auto dealership independent of that also qualifies? We aren't quite certain on that at this point. We're continuing to monitor that. At this point, it's kind of if you're under 500 across all locations, you're good to go. If you're under 500 per location, there's a chance that you may be able to qualify for it. We're expecting to get some more information on that as the procedural guidance comes out. This program will be available for self-employed individuals as well. This one, again, there's not too much information yet. It would probably be associated with the individual Schedule C for the prior year. The Treasury Secretary Mnuchin, has come out at a few of the White House briefings with some statements. During yesterday's briefing, he mentioned that applicants should expect the program to be available by the end of what would be this week now, or Friday, April 3rd. And in a previous briefing, mentioned that applicants should be able to both apply for and receive the funds in the same day, which through a government program that would be pretty good if they're able to pull that one off. We have reached out or have heard from some of our contacts at various banks, and those representatives have mentioned to us that they're not expecting to actually get info on this loan program until this Friday, which would suggest that if the banks are still just setting up for the loan on Friday, you might not be able to apply for a week from today being Monday. So until the week following the 3rd. At this point, it's kind of we're just monitoring this to see when that guidance comes out. So if you're kind of scrambling, wondering, what am I missing? Where is the web page for the application on this? Why can't I find the right info? You're not missing out at this point. This was just signed into law. Banks are still getting started. There's no set application spot or anything like that at this point. So calculating the amount of the loan you can actually take. So the maximum loan amount is equal to the lesser of either your average monthly payroll cost multiplied by 2.5 or $10 million. So what that just means is they're looking at your payroll costs on a monthly average, and then they're giving you 2.5 months worth of that. So that's why I say this is going to allow you to cover for 2 months of your employee's pay, and that extra half month goes towards various other qualifying costs, which we'll get into. Payroll costs, as it relates to calculating that average, is salaries, wages, and commissions up to $100,000 per employee, excluding payroll taxes, which, as we interpret that, means if you have, employees that are making $120,000, $150,000, for example, you still get to factor them into this calculation, but only up to the first $100,000 of their pay. Additionally, you get to factor in cash tips, vacation, family, medical, sick leave, excluding the amounts that you get credit for under the previous program that we had just gone through. Group health benefits, including premiums, retirement benefits, which is most likely the matching. So you take all those costs, you look at those, and we'll have an example. You look at all those costs for the year preceding when you applied for the loan, divide that by 12 to get your average, and then multiply by 2.5 months, and that's the max amount of the loan you can take. So after you determine your maximum, the next big piece is, what can you actually spend that on? So for that, you're looking at payroll costs as we previously defined it, interest expense on mortgage, rent expense, utilities expense, and interest on other debt obligations incurred before February 15th of 2020. So for all these items, you're generally looking at expenses. So like utilities that you've entered into an agreement prior to February 15, 2020. Rent, you're looking at lease agreements prior to February 15, 2020, that kind of thing. To touch on some of these specifically, so the interest expense on mortgage, I don't think there's anything specifically in the bill that is forcing the those that are processing the mortgage to halt the principal payments. But if you do reach out to your loan servicer, a lot of these are now allowing for a temporary period for you to just pay interest expense on the mortgage, and that piece of it is what you can use this loan for. So if you're not sure if you have the cash on hand over these next couple months to be able to pay the principal amount, maybe reach out, see if you can come to an agreement to just do interest expense for a period of time. For the rent expense, you're going to want to have a lease agreement in place for that. The lease agreement is going to have to be from before February 15th of 2020. We've received a few questions on whether related party, like self-rentals will qualify for this. At this time, it's unclear. As it's written, the only real requirement seems to be that there's a lease agreement in place. Whether through further guidance they restrict that to exclude related party rentals is yet to be seen. But I would say that if nothing else, you should at least make sure that there's a lease agreement in place to see if you can take advantage of that. And then for interest on other debt obligations incurred before February 15th, we've gotten for auto dealers, a few questions on if this means you can pay your floor plan interest with this loan. As we interpret it, it means that if it's floor plan related to vehicles, this was taken before February 15th, then you can pay that interest. Whereas if this was after February 15th, you can't. So you may have to do some type of analysis or summary just to determine for whatever interest you're paying, what portion of that relates to debt prior to February 15th. So those are the expenses you can pay. And then the way the loan forgiveness works, so this is, a huge piece of this loan package is, after you've determined how much you can get, how much of that are you not going to have to pay back? To summarize it, it's going to be the amount of expenses you pay during the 2 months or the 8 weeks following the loan origination or from when you get the loan. The expenses that you get to include in this forgiveness are payroll costs, interest expense on mortgage, rent expense, and utilities expense. So as we've read the bill, it's, again, the actual application process is we're still waiting on some guidance on that. But it seems like the lender is going to be expecting some type of budget or some type of estimate of your 8-week expenses following the application so that they can determine an estimated amount of loan forgiveness on that loan. So what you're going to want to do is you're going to want to look at, we'll get into whether or not you're going to hire employees back, but you're going to want to estimate the amount of payroll costs, interest, rent, and utilities that you're going to pay during those 2 months following the loan. And then that amount is going to assist you in calculating how much you don't have to pay back. After you've determined that amount, so say you've hammered down a number of what you expect over the next 8 weeks to pay, then there are just some other hurdles to see if the amount that gets forgiven is reduced. So to summarize this first bullet where it mentions full-time equivalent workforce in the 8 weeks following the loan versus either of these two periods, basically what they're looking at is, did your workforce shrink in the 8 weeks following the loan versus in the time periods prior to the coronavirus issue? So you can pick either February 15th of 19 to June 30th of 19 or January 1st of 20 to February 29th of 20, whichever is a more favorable period. And then you're going to want to look at the amount of employees full-time equivalents here in the 8 weeks following the loan. Now this is for an average of your full-time equivalent workforce in the 8 weeks following the loan. So say, in the last couple of weeks you had to lay off 50 employees. When you go to apply for this loan, it's advisable to probably wait until you've actually, secured this loan before you hire anybody back, because, you wouldn't want to run out today and hire employees if you're not going to be able to get the loan next week and you can't cover the payroll. So once you get the loan, at that point, you could then hire back the employees to make up that difference between your employee count prior to coronavirus and now in the 8 weeks after. And if you have at least as many employees as you had before or more, then the amount of loan forgiveness will not be affected. If, say, you have 10% less employees in the 8 weeks following on an average basis, then you'll only be able to forgive 90% of the expenses that you've calculated for the 8-week period. Another piece of this is the forgiveness of the loan gets reduced by the amount of decrease in any single employee's salary or annual wage in excess of 25%. So what that means is if you're looking at, say you have an employee that has $100,000 salary and, due to this whole situation, you've cut their pay down to $75,000 by only 25%, then that won't affect your loan forgiveness. However, if you cut their pay by 30% down to $70,000, that 5% difference or the $5,000 difference is going to directly impact and directly offset the amount of loan forgiveness that you have. So the key thing there is you want to restore your workforce count at least up to the amount you had prior to the crisis, and you don't want to cut anybody's pay in excess of 25%. You want to leave them at least 75% of what they were making if that can be afforded, and then that'll give you the maximum loan forgiveness through this program. The amounts that are forgiven are treated as non-taxable cancellation of debt, meaning that you don't have to repay it, and it's, of course, non-taxable. So that kind of harps back to the point that this is more of a grant program than anything. For the amounts that are not forgiven, you have loan terms of 10 years at a maximum interest rate of 4%. with a 6-month deferral before payments are required. So those are pretty lenient terms. So again, say for example, you had $2.5 million as your maximum loan, and you calculated $2 million of expenses during the next 8 weeks. That remaining $500,000 would be repaid over 10 years at a max of 4%. So this also means that you may want to take the max amount that you can take if those loan terms seem favorable to you. So again, if you only expect over the next 8 weeks you're going to pay $2 million in expenses, even though that's more than the max loan you can get. If paying $500,000 back at 10 years, 4%, if that seems like a good situation for your business, then you may want to just maximize the loan, regardless of the amount of expenses you expect over the next 2-month period. Now we got an example, working example of this loan program. So Auto Dealer is a business looking to apply for a Paycheck Protection Program loan under the following circumstances. They have less than 500 employees, this being under, whichever interpretation, just for the purposes of allowing them to qualify for this program. Their annual payroll costs total $12 million. They expect to pay $2 million of expenses in the 8 weeks following the loan. Their average full-time equivalents prior to the crisis are 250 employees, and average full-time equivalent in the 8 weeks after the loan of 220 employees, meaning, the employer in this example didn't hire back at least 30 employees, and there's been a reduction of employees pay in excess of 25% of 100,000. So this means that you had several employees that their pay was cut by more than 25%, and the dollar amount of that was 100,000 in total. So in calculating the maximum loan amount, you've got $12 million divided by 12 months. That gives you your average total monthly payments of $1 million. Multiplied by 2.5 months gives you $2.5 million as your maximum loan amount. For the forgiveness portion, you have $2 million is what you expect to pay over the next 8 weeks. Now, because, again, you only have 220 employees, before that you had 250 employees, you only have 88% of the workforce from beforehand, you have to reduce the amount that you can forgive appropriately by that percentage, so it knocks off 12%. And then the workforce pay forgiveness reduction, this was the 100,000 of employee pay that you cut in excess of 25%. That also reduces the amount you can forgive. So your net amount that you can forgive that you won't have to pay back, it'll be non-taxable, is $1.66 million. Summarizing that, you had a max loan of 2.5, expected forgiveness amount of 1.66, leaves you with 840,000 payable. This will be over 120 months or 10 years at 4%, and your monthly payment on this would be $85.05. We do have an Excel spreadsheet work paper that calculates the estimated maximum amount of the loan, the forgiveness amount. It summarizes some of the key information that the lenders will be looking for. This is one of the pages of that. It just spits out a nice summary of the loan, the maximum, the forgiveness, and the loan terms for any amount that does have to be repaid. We should be able to get that up on our website as a resource, but otherwise definitely feel free to reach out to any of us, and we can look to get that out to you. So as far as applying for the loan, so as I mentioned before, the application process, even though this was signed last week, it's not fully in process at this point. We're still waiting for additional information for exactly what the lenders are looking for. But based on the text from the bill, they're going to be looking for payroll tax filings, state income tax filings, canceled checks to substantiate your expenses. We have here April 1st of 19 through current. Reason being that the text requires you to show your average monthly payroll for the 1-year period previous to applying for the loan. So this is on the assumption that everybody's going to go out, as soon as possible this week, next week, and apply for this loan. If you did end up waiting till the end of the month, you would want to adjust that date accordingly. If you applied at the end of the month, maybe April 25th of 19 through current, that kind of thing. That being said, if you are able to get it in at the beginning of April, that'll be pretty clean to be able to look at the 3 last quarters of 2019 and then the first quarter of 2020 for that information. So that might be an extra motivation to get this loan as soon as possible. Just for getting this information together, it might be easier if you're able to do it right on a quarterly basis. And then they are going to be looking for support to verify the amount of mortgage interest that you're going to be paying, your rent obligations. They'll look for the lease agreement, and then utility obligations, whether it's invoices, canceled checks, items like that. There is a requirement in the text to self-certify that the uncertainty of the economic conditions as a result of the coronavirus has led you to request this loan, and that you'll be using those funds to retain workers, maintain payroll, or to make your mortgage interest, lease, and utility payments. So at this time, based on the language in the text, there's nothing in there that says, you must be able to show that your business now has, X% less revenue this year versus the same time frame last year, or the value of the business has been impacted by this X percentage or anything like that. Based on the text, it seems like it'll just be a self-certification statement. There may be some statements on a page that say these last 2 bullet points, and then a representative of the business just has to sign off on that to certify that's the case. Some practitioners have already started, and we might build a template too, maybe like a summary letter that gives a general overview to the lender of how your business has been impacted by the coronavirus. So at this time, we're waiting on that procedural guidance to know exactly what you have to provide. But based on the text in the bill, it seems like they're trying to be relaxed with this requirement and just have a representative sign off that, I was impacted by coronavirus. I need this money for these expenses. And if they're able to substantiate those expenses with, the payroll tax filings, the canceled checks, etc., then that should be sufficient to apply for the loan. We'll have to wait and see if that's the case. The next section is the rebate program. So this is, and I do, before I touch on this, I just want to wrap up the small business loans. Small business loans seem to be probably the best resource right now for those that are able to take it. This gives you an immediate injection of the amount of money you need to hopefully pay for 2 months worth of payroll, keep everybody on board. You got that extra half month, which should hopefully cover the cost of utilities and rent. If you end up spending less than that, you have favorable loan terms. Everybody's, you're going to want to budget that out. You're going to want to look at those next 8 weeks, not only for the application process, but just so you can account for it. Because if you're going to have all this money coming in, you don't want to just be throwing it out there without budgeting out your resources. So definitely look into this loan program. It's very favorable. Some parts of it seem too good to be true, but again, this program is here so that the federal government can inject the money into these businesses to get it out to the employees, almost like a conduit by using the employer to do it. Rebate program. This is hearing a lot on the news stories. Up to $3,400 for a family of 4. So this provides a refundable credit of $1,200 for a single filer, or $2,400 for married joint filers, with an additional $500 credit for dependent children under 17. So that's where they're saying, filing joint, $2,400 plus 2 kids, family of 4 gets $3,400. And the amount of this rebate is non-taxable, so that's a benefit as well. Eligible taxpayers will include generally all taxpayers, anyone that's a U.S. resident or citizen that has a Social Security number. The rebate does phase out for higher income taxpayers. For single filers, you get it. It starts to phase out at $75,000. It's gone after 99. For married filing joint, phases out between 150 to 198 for those without children. Now, the way that this program works is it does go onto the next slide. It does go based on your 2019 income initially, and then it is recalculated on your 2020 tax return. So what that means is it will look at your 2019 tax return information as filed, or if you haven't filed a 2019 return, it'll look at your 2018 tax return to see if you've hit that $75,000 for a single filer, for example. And then come 2021, when you go to file your 2020 tax return, it's going to calculate this credit based on your actual 2020 info. Now, this actually ends up working out pretty well for taxpayers. So if, say, for example, your income was too high in 2019, but you get laid off and your 2020 income ends up lower, and then you're eligible, when you go to file your 2020 tax return, you'll get that additional credit at that time. In the opposite sense, if you qualify for the full credit in 2019, but in 2020 you end up making more money, Senate Finance Committee member Chuck Grassley has mentioned that the excess will not have to be paid back. So you kind of get a benefit on both ends. So if you deserve more in 2020 based on your 2020 return, you'll get it. And if you deserve less, it won't have to be paid back. The payment of this rebate will be either direct deposited within about the next 3 weeks, or mailed checks are expected within the next month and a half, or 4 to 6 weeks. Now jump into tax provision changes. Individual taxpayers first up. Required minimum distribution is waived for 2020. There is a $300 charitable cash contribution above the line deduction for taxpayers taking the standard deduction. So many of you may have noticed that under the recent Tax Cuts and Jobs Act, there were a lot, because of that state and local income tax deduction cap, a lot less people were able to itemize in the prior year. This new charitable contribution deduction allows you to take $300 deduction even if you only take the standard deduction. So if you haven't made a contribution for the year and you were looking to do so, that first $300 you're going to get to take as a tax deduction no matter what. Payment by the employer of 2020 student loans will be non-taxable to employees for up to $5,250. There are relaxed rules on early retirement withdrawals as related to coronavirus. So if you have to take up to $100,000 out, the 10% early distribution penalty will be waived, and the distribution is both taxable and may be repaid over a 3-year period. There is an election if you find yourself in certain circumstances where you'd rather pay it back in the first year. There is an election to do that as well. And then they've also expanded the amount and the terms of loans from qualified employer plans. There's also a retroactive delay of the excess business loss rules until the 2020 tax year. So what this was another piece of the Tax Cuts and Jobs Act that essentially limited you to $500,000 of losses, business losses for a married joint couple. And this meant that if you had losses in excess of that, it kind of got pushed forward to the next year and you didn't get to utilize it in the current year. This change retroactively delays the implementation of that provision. So if on your 2018 or 2019 return, if you had really big losses in excess of that 500 that you otherwise wouldn't have been able to take because of this rule, it's worth looking into, if your returns have been filed, looking into whether it's worth amending to make that change. And this, paired with the net operating loss rules that we'll be showing shortly, could allow you to get a nice reduction against your prior year tax filings. Taxpayers, First, we'll start with the areas regarding payroll taxes. So there's a refundable payroll tax credit of up to 50% of the first $10,000 of wages per employee. And this credit goes against employer payroll taxes. However, this provision is not available to businesses that obtain the loans through that new small business Paycheck protection program. And from at least our first glance, any benefit you'd receive through the refundable payroll tax credit, especially because everybody needs the cash now, wouldn't outweigh the benefit of the Paycheck protection program. Similarly, there's a delay of payment of 50% of 2020 employer share of payroll taxes. So you can delay paying your 2020 Paycheck protection loan program. So if you do find yourself over the 500 employees and maybe relief isn't available for you through that new loan program, you could look to these provisions to see if those could help you. There is a net operating loss 5-year carryback for losses arising in 18, 19, and 20. So prior to the Tax Cuts and Jobs Act, you used to be able to carry back your net operating loss, but after that tax reform happened, they made it going forward only. This change allows you for 18, 19, and 20 to carry it back. So if you did have big losses in 18, or if you've already filed 19 and you had large losses, it may be worth considering an amended return to see if, or a carryback claim to see if you can get additional money back through that. It expands the interest expense limitation allowance to 50% of adjusted taxable income. So this is, the Tax Cuts and Jobs Act introduced a limitation where you could only deduct your interest expense up to 30% of your adjusted taxable income. This piece of the CARES Act expands that out to 50% of adjusted taxable income, which allows you to take a larger interest expense deduction. Hand in hand with this, especially for auto dealers, if you'll remember recently, towards the end of last year, auto dealers were once again eligible for bonus depreciation if all interest, including floor plan, didn't exceed 30% of adjusted taxable income. That also ties to this 50% change. So if you were right on the cusp back, if 19 has already been filed and you were right on the cusp for taking bonus but you couldn't get it, you may be able to now take it in 2019 and hopefully for 2020 as well. Because this interest limit is tied to your taxable income, and because they're expecting people to make less money obviously in 2020, you're allowed to use the figure from your 2019 tax return to determine your interest expense limitation for 2020. There's an election that allows you to do that. And because most businesses are experiencing, much less revenues as compared to prior years, this will be a great help for stopping you from losing your interest expense deduction entirely. There's finally a fix for the qualified improvement property. Some have called it the retail glitch. This was the non-structural internal improvements were supposed to get a 15-year life under the Tax Cuts and Jobs Act, but because of an error in writing, they were stuck with a 39-year life, and they couldn't get bonus depreciation. So they fixed that in this legislation. It now gets a 15-year life. It's allowed to take bonus depreciation, and it's a retroactive fix. So again, looking back to 18 or 19, if you've already filed, if maybe there were some improvements that we weren't able to write off entirely using bonus depreciation before, this now has a 15-year life. It may be worth revisiting to see if there are additional deductions you can take from those prior years to accelerate your deduction. And speaking of acceleration, there are acceleration of prior year minimum tax credits. This relates to like alternative minimum tax, which generally shouldn't be too applicable for most of the businesses your size. But if there is an acceleration of those as well. Unemployment did get an expansion. It expanded unemployment to also include self-employed and independent contractors, which is great for those that aren't able to engage in any work at this time. One of the big pieces that has been running through the news cycles is the additional $600 per week in unemployment for up to 4 months. So just before this bill passed the Senate, a group of one of the party members or one of the parties had tried to get an amendment in place that would limit that additional $600 a week so that a former employee couldn't end up getting unemployment for more than 100% of their lost pay. However, that amendment did not make it into the bill. So as it reads right now, you get the additional $600 per week. However, in the last 2 days of White House briefings, the president has explicitly referred to this provision as up to 100% of your previous pay for 4 months. And he went as far as to say that if the states weren't able to implement that, he may call Congress back to make a change. So whether it's through Congress or if it's through a regulatory process, it sounds like the intent, at least by the president, is to cap that $600 at no more than 100% of your pay prior to unemployment. But we'll have to wait and see if that ends up, if that change makes its way through. An additional 13 weeks of unemployment were funded or provided through December 31st of 2020. And there's also short-term compensation programs where employers can reduce the amount of hours instead of laying off workers, and then unemployment will make up for the difference in the employee pay. So here's our contact. My first one at the top there, rmcdonald@ocd.com, or feel free to reach out to either Mark or Kevin as well with any of your questions. A copy of this presentation and a recording of the webinar will be available at our website. We're going to have a landing page for these resources, as well as some of our other constant contacts and potentially some of our templates all through one page. And there's also a link here of the U.S. Chamber of Commerce's Paycheck Protection Loan Summary. It's a nice 4-page PDF summary of high level of all the provisions regarding that loan program.